Hey guys, welcome back to the channel, your number one source for income-oriented investing. I figure I'd make a super quick video about the IWMY or IWMY ETF that just came out or recently came out from Defiance ETFs, along with, of course, QQQY and JEPY. Do a super quick video. It's not going to be that long. I'll talk about this ETF. More importantly, I want to talk about if I'm going to be investing in it or not and my reasoning behind that. So IWMY is basically does the same exact strategy, the same exact thing like JEPY and QQQY. The only difference is the index. It's on the Russell 2000 index. So I'm not going to go over how these ETFs works. I already covered it in two previous videos. If you want to check those out, guys. The best way to look at anything to do with US funds is I have a specific playlist. You got to go and click on my channel name, go to playlists, and one of them will be called US listed funds, designed for high yield and passive income. And the very two ones at the top, the most recent ones, were on the Defiance ETF. So this one here is the key one, I would say, where I interviewed the CEO. We talk about these ETFs, how they work, about the strategy, and even this one here, which I recently did to analyze the behavior of QQQY and JEPY, and it really, really proves to show you that it really acts like a covered call ETF, basically. So not going to go into how this ETF works. Watch those two videos in case you haven't seen them already. So getting back to this ETF, now, the first distribution was declared, and just like JPY and QQQY, the first one is going to probably be the biggest one, and they're going to go down a little bit with time as the net asset value goes down as well. So absolutely monstrous $1.25 monthly dividend here. That could get you pretty excited, but in case you didn't know, what is the Russell 2000 index? Because that's the index that this ETF is based on. As we know, these daily options are only available on the indexes. I guess it's available on the Russell 2000 as well, because it does say daily options here. So the Russell 2000 index, if you just put RUT, R-U-T, index in Google, you'll get the actual index. It's basically 2,000 small cap companies in the US stock market. It's actually the 2,000 bottom companies of the Russell 3000 index. So Russell 3000, everyone, is kind of like top 3,000 companies in the US, right, by market cap, I believe, just like the S&P 500 is the top 500. Well, the Russell 2000 would be the 2,000 bottom ones of the Russell 3000. So it's really an index to measure the small cap stocks in the US stock market, but you are getting an index and you're getting exposure to 2,000 companies. And the most popular ETF is really from Vanguard, the VTWO. If you actually look at RYLD, the Global X Russell 2000 covered call ETF, you'll see the biggest position is VTWO. So this is probably the biggest, most liquid ETF that covers passive index ETF that covers the Russell 2000 index. So you're really getting your exposure to the small cap stocks here, and this is really the reason why I myself personally will not be investing in IWMY. Now, as you probably already know, I pretty much, in my retirement accounts where I invest exclusively on the US stock market, pretty much went all in on QQQY and JEPY, the NASDAQ 100 and the S&P 500 one. So I've been getting a lot of questions. Are you going to pick up IWMY and how much? Well, the answer is no. I am okay with just having the QQQY and JPY, the S&P 500, the NASDAQ 100. And this is my reasoning behind it. When it comes to, even though you see that the yield is the highest so far when it comes to the first distribution, but you got to realize that whether it's a covered call ETF or whatever, the biggest indicator of your performance long term is really the underlying holdings, right? So obviously with JPY, it's going to be the S&P 500, and with QQQY, it's the NASDAQ 100, and with this one, it's the Russell 2000. So if we look at the actual performance of the Russell 2000, this ETF has been out there for more than 10 years. So if you have more than 10 years of data, you could actually get an accurate forecast of more or less how this ETF behaves in terms of performance. And if you look at the performance, I mean, last 10 years on average 6.19 since inception 2010, so it's about 14 years, 9.32% a year. So not so bad. But if we compare to the S&P 500, which we'll just look at the exact, we'll stick with Vanguard here, VOO, right? Everyone knows VOO or the SPY or whatever. It's the S&P 500 passive index ETF. You'll see that it's not even close. The last 10 years, 11.77. Since inception, since 2010, 13.58%. So the S&P 500, and we won't even compare it to the NASDAQ because the NASDAQ 100 is actually beating the S&P 500. So it's going to outperform VTWO even more than VOO. So we won't even check that out. But my reasoning behind it is I feel like the big cap, the big boys, even in the last 10 years it did, and probably in the next 10 years or 20 years, and maybe even in my lifetime, will continue to beat the small cap stock. That's just my opinion. I could be wrong. Maybe the small cap stocks will explode and beat the big cap stocks, but I heavily doubt it. I think the main reason is really the composition. If you look at the portfolio composition, there's not much tech in there, right? Compared to the S&P 500, there's only 12% tech. So in the Russell 2000 index, you got a lot of stuff like consumer discretionary, industrials, financials, a lot more energy. Whereas the S&P 500 and the NASDAQ 100 even more, you'll have a lot more exposure to what I feel are the most important companies and are going to be the biggest growth drivers, just because we're going into a digital technology age, is going to be the technology company. So if you just do like a comparison, VTWO versus VOO in terms of total return, it's not even close, guys. You see that the S&P 500 is beating it. So when it comes to a covered call ETF, guys, I feel, my opinion here, I don't even think it's a matter of opinion. The biggest performance driver, what dictates your performance, is really the underlying. It's the stocks inside. In this case, it's a Russell 2000. So this is why I'm not going to be picking up IWMY. Doesn't mean you shouldn't. If you're very bullish on small cap stocks, for example, you think the Russell 2000 is going to explode. For some reason, it's going to beat the big cap companies. You could go ahead and get it. I'm not saying it's wrong. I'm just giving the reason why I personally won't be investing in it. I am okay. I really prefer myself personally here to stick with the big cap stocks, the big cap indexes. So I am okay just having the JPY and the QQQY. So again, in case you missed the videos, you're wondering how the hell these ETFs work, daily options, in the money, put options could be very confusing. Check out these two videos because they actually perform, or they behave exactly like a covered call ETF. So they're really not, they sound complicated. If you read it, it is complicated, but if you actually look at the behavior, like I show in this video here, check out this video where I've been watching them for like a month and I show you the behavior, you start to understand really easily how they work. They work exactly or pretty much very similarly to a covered call ETF. So I hope this video was useful for you. Give me a thumbs up. I would really appreciate it, and more to come on these Defiance ETFs and these high yield covered call ETFs. Goldman Sachs just launched two of their own, which are direct competitors to JEPI and JEPQ. So I'm gonna have a video, make a video on that as well shortly. So see you next time.